What's up everyone, this is Warren Howe. Hope you're having a great day out there as always. Now in this video we'll try to keep it short. We'll be talking about the potential moves that we are making, have made and are trying to make in this to take advantage of this market event right now. We will be talking about how can we potentially hedge our portfolios, what is our thought process, our mental models to develop in, because as we all know stock markets are actually going down, but our convictions shouldn't be going down with them. Yep. So appreciate it if you haven't, that you can subscribe to our channel, right? Drop a like if you enjoyed this video, and let's begin. So first of all, I want to say that I did not anticipate this because I did not think that Putin will risk Russia's GDP, Russia, invading Ukraine and causing this war. Because they officially declared war over Ukraine and what was called just a military operation. So I did not think they'll do this, and we can't control Putin, obviously. But what we can control is what we do in our portfolio. What is the moves that we make, build the thesis that we do, be in a position of power to be thinking that, okay, this is purely market sentiment, right? Purely market sentiment. So, but we have to understand the macro events and what's happening before we actually make a good decision and to be, buying or selling certain stocks, trimming or buying more. We should be doing all of this. Now, let's talk about the macro a little bit. Yeah, and this is actually, we talked about this before in the video, the 55-minute video uploaded on YouTube as well. You can go check that out in a recent video. We were live with Sifu, right, stock platform, and we addressed this into detail. But just to repeat that, basically, why is oil and gas prices going up? Why is oil going up? Simply because of supply shortages, right? So other than potential bombings on pipelines, shutdown of factories, shutdown of oil production, to stop supply, and knowing that Russia controls production of the third largest in the world, global production, right? They have around 11, they're responsible for 12 to 13% of global production, oil, and 17% of natural gas. Yep. And obviously Russia is a big metals hub. Yep. So why am I bringing that out? Is because with this in place, we would expect supply chain disruptions, we will expect supply shortages, and that will obviously, that jacked up the price, which literally we can see now US oil at 97, UK oil at 103, Brent, and these are very, very distressed times, right? Now, what are the effects fundamentally for certain countries and certain stocks? Now, if we, knowing the global macro scenario, Russian oil, 50% of Russian oil is actually supplied to Europe. Right, so think about all the countries that are importing and not self-reliant, not producing oil, and they're depending on Russian oil. They will be fundamentally affected, right? Economically as well. Well, overall it's affected because your oil prices are going up, but directly, especially on stocks in Europe. So if your investments in Europe, you will probably have sentiment actually going bad there. But fundamentally in the US, right, for them being self-reliant, they're producing all themselves, they would not be as affected. Yeah, and everything is just market sentiment. Now that's one clearer picture. The other thing is that natural gas, third quarters of Russian natural gas is actually supplied to Europe as well. Yep. So imagine Korea, France, all these sort of countries actually depending on Russian oil will be affected, right? And so what comes to play? What comes into mind when we think about commodity plays and how do we capitalize off this, right? So this is pure commodity play. This is a pure play that we are following earnings, potential earnings, and knowing the stock market, everything, reflecting everything earlier. Essentially, this is where traders will benefit because just riding off that hype, or better yet, if we combine fundamental analysis and technical analysis, we do DUD on certain companies. So I got 4 stocks here, which are all upstream oil and gas players, right? It's simply as simple as their average sales price increasing because of the oil price increasing. They can literally sell their oil that they have dug up or drilled and produced and sold off. Their profits are actually essentially going to get better because the cost of OPEX, the cost of CAPEX is actually still stagnant, but their ASPs are increasing. So that's where I'm following. And if we combine these two, fundamental analysis and technical analysis, we can essentially make a great trade, right? We can essentially make a great trade. Now, that's what I want to share with you to capitalize on in these events, right? So we got a war happening. We talked about the macro events, and logically, we got a company based in Singapore. We got a company based in Malaysia. This is not limited to just Singapore. They have contracts in Norway, Rex International, right? And there's the US, right? US companies, and these are all upstream players. Now, upstream players as well, they have better margins, especially at these times, right? So logically, it's a no-brainer trade in my opinion. Realistically, they are oil and gas price hype beneficiary. So I'm looking at Rex International, where fundamental analysis tells me that potentially forward PEs could be at 3 to 5. Current PEs are at 15. This is a sector, energy sector has been beaten down past 2 years. Last year was actually great, the past 3 years, right? And now they're actually climbing back up, and they have all the more the reason to, because because of rising oil prices. Now, if this war continues, right, and it's good both ways for these companies, right? So if this war continues, their profits will get better, obviously, from the price hype. If it's a short war, we could also just have a potential thematic FATA trade. Now, I'm not an ONG specialist, I'm not an ONG expert, but I'm just looking at these events and I'm just capitalizing on this. And I'm not going to marry the stock. The maximum I'm going to hold these companies is probably around 6 months, which, that is good enough for me, right? Hopefully it plays out. Yeah. So we have made moves in Hibiscus, we have made moves on Devon, we're going to make moves in Rex. Oh, well, yeah, Rex. And but their PEs right now are actually insane. Yeah, they have made big oil moves. What matters is the forward PE and whether or not the valuation is priced in. But analysts have oil prices projected to be around 120 to 150 should the war break out, and it's officially starting to. So that's where I personally think our money should be at. Energy sector, XLE, all these particular stocks, right? So again, this is not a buy or sell call. This is educational purposes. Please do your own due diligence, but this is one of the potential trades that I personally am doing to be hedging my portfolios. Now, the second thing I want to talk about is, what if this war actually breaks out longer than usual, right? What if this war breaks out longer than usual and things are, going messier and messier? And how will rising oil prices actually affect the economy, especially in the US or Malaysia? Now, for every $20 per barrel that goes up, that is an additional 50 cents of gasoline prices for the US, right? Right now, gasoline prices, not mistaken, around $3.50 per gallon. Based on the highest since 2014, and that's a problem simply because of inflation itself, right? So if our companies are heavily dependent on consumer spending, and where money flow is actually going lesser on certain objects, or especially consumer discretionaries, then that would be a problem fundamentally for our stocks in the US, or especially specifically in the US. Yep. So that's another problem where inflation actually goes up higher. But like we said, we got natural gases now, we got aluminium, right? Metals. Essentially, Russia's a big metal hub. Maybe we could be hedging and going into these plays. So what is this? We got silicon metal, we got lithium, we got basically inflationary beneficiary or commodity plays that we can go on to. We are personally going into them. Right, this is actually how we can hedge, right? So in FATA and FACADEMY, we talk about the 70-30 portfolio. The 30 will actually be hedging on there, as you guys already know. If you've been following us, you'll know. Yep. And the third thing I want to say is that whether we like it or not, and we have to get an educated guess on this, will this war last long, or will it last, very short, right? In my opinion, this is actually just a short war. Yeah, this is a short war, and I want to share something that I personally share with my group, my Discord group. Click on the link below if you want to join the group. And this is basically, from LPL research, right? So geopolitical events and stock market reactions. How long did it take to bottom out, and how long did it take to recover in calendar days, right? So we got Iranian general killed. Okay, that was not. We have Saudi Aramco drone strike, 19 days, 41 days to recover. The longest is actually from there's two. So we got Iraq's invasion of Kuwait, which is 71 days, and it took 189 days to recover. And we got the Pearl Harbor attack, which is 143 days to bottom out, and 307 days to recover. So that's 10 months of recovery, and it's around 6 months to bottom out. Now that means we have 6 months to average down. I'm just kidding. But actually, that's in a way we do, right? In a way we do. So if we follow historical events, and logically, if we assess this with an educated guess, I wouldn't even put this war at Pearl Harbor attack. I would probably put them at 42 days to bottom out, or maybe even longer, maybe even 3 months maximum, and then essentially 4 more months or 5 more months, possibly 6 to recover. Now, my point is, that's where we have the mindset, right? So this is what we initially said. Are your stocks fundamentally affected from this war? Now, obviously, it will be a longer run, right? Similar to long COVID, where we will get affected on inflation, where consumer spending will be worse. But what is the guidance that your stocks have been putting out? Yep. What is the fundamentals actually done? Are their products still sexy? What is your buy plan on these stocks? How long are you going to hold them for? What is your projections done on these stocks? If your projections and everything checks out, they are solid, your criteria are solid, everything that's happening right now in the world, we got S&P 500 futures actually dropping like crazy. We got NASDAQ futures dropping like crazy. From the highs, they're down probably 15%, 10, 12, 15%. Now, we have to think whether or not we can stomach this volatility. Because if everything is pure sentiment and the fundamentals are actually getting better, we all know that we should be dollar cost averaging, right, on certain stocks. So this is what I'm trying to say. Assess whether or not fundamentally this war will affect your company, and that's the beauty of holding one company. Assess whether or not your companies will still continue to grow and their guidance will still kill it. Yep. Are their prices lower than where they were before, but the fundamentals are actually getting better? And this fundamental getting better is actually subjective. It's all whether or not, it's all come to growth, revenue growth. It comes to earnings growth. It comes to their valuations, their deserved valuations. It comes to whether or not they are having optionality, innovating, the management, strategy, everything. Yep. So if everything's getting better, so we shouldn't be freaking out. Because this is where some of our members are actually saying, okay, Warren, shit's about to get down. Shit's about to get ugly. My stocks are actually going down. But we are treating them as stocks. We're treating them as a ticker symbol, which we shouldn't. We should look at them as an underlying business. And fundamentals don't change overnight. They don't change in 3 months. That's where I have to share this with you, right? That's where we have to logically think that we're owning businesses. And that's where we have to develop the right mental model to be going on this, right? And this is something that I want to share as well. This is from Fundstrat, Tom Lee. The guy is a perma bull from Bloomberg. Basically, he's trying to say that every time there's a war, there's a Vietnam War, there's an Iraq War, Gulf War, whatever it is, and there was an invasion, buy the invasion. Now, I'm not trying to encourage, again, I'm not giving you buy or sell calls. Please do your own due diligence, especially on those stocks that we shared just now. But every time there's a war, we have to assess and, educated guess whether or not it's a short war, is it a long war, is it really impacting our companies, what is our thought process, what do we do, is it purely market sentiment? Because as we all know, market controls. The reason why the stock prices are actually going down is because 40% is based on market sentiment. And that's huge in the stock market. If we're holding great businesses, we can ride it out. So in 2 years' time, we'll be laughing, and we'll be, 3 years' time maybe, because I'm not sure whether it'll be a recession. There are more headwinds in this year. But if our portfolio allows it, we could develop a dollar cost averaging strategy. Yep. So again, I hope you guys got some value out of this. We talked about the macro event, what is happening. We talked about potential trades that we can capitalize on. How should we hedge our portfolios? Because we can, we got energy, we have aluminium, we got metals, natural gas stocks that we can actually potentially hedge on. We talked about mental model and thought process. So, again, if you guys haven't, appreciate if you can subscribe to our channel, drop that like if you enjoyed this video, and I'll see you guys in the next one. Thank you.